Right now, metal markets are buzzing about a quiet showdown between platinum and palladium, two platinum group metals that power everything from catalytic converters to jewelry. Global inventories wobble, supply chains face disruptions, and investors wonder which metal offers resilience, growth, and real-world usefulness. In electric vehicle and refinery cycles, small shifts in demand can swing prices dramatically. The question we explore today is not merely which is cheaper, but which offers better risk-adjusted upside across cycles, industrial need, and policy shifts. Understanding this choice matters for miners, manufacturers, and savers alike. This video breaks down the factors shaping price, use, and opportunity. Platinum and palladium are both rare metals in the platinum group, prized for durability and catalytic properties. Palladium has dominated auto emission controls for years because it works well in compact engines and is easier to source, making it cheaper to refine in some cycles. Platinum, by contrast, is heavier and more versatile, valued for durability in jewelry, industrial catalysts, and potential substitutes in green fuel cells. Prices move with mine output, processing costs, and demand from car makers, electronics, and investors. Right now, disruptions in South Africa, Russia, and India influence supply, while rebounding demand tests metal market stamina. The mix of drivers matters for buyers and sellers alike. Historically, platinum and palladium rose from different beginnings. Palladium surged in the late 1990s as automakers faced stricter emissions standards, riding a wave of demand from catalytic converters and growing car fleets in Asia. Platinum, by contrast, is heavier and more versatile, valued for jewelry and industrial catalysts. In the 2000s, mine closures in South Africa tightened supply, while palladium shortages pushed prices to record highs in 2020-2021. Exchange-traded funds and futures created new price signals, turning a physical metal into a tradable asset class, with liquidity and headlines. Investors learned metal markets respond to policy chatter. That connection guides long-term decisions. Today, the market posture mixes higher volatility with pockets of resilience. Palladium remains more price-sensitive to auto demand, while platinum benefits from a broader industrial role and investor interest in hedging risk. Price charts show palladium near multi-year highs, then retreating as supply expectations shift and car production cycles normalize. Platinum has traded in a wider range, reflecting jewelry demand and industrial use. ETFs and mining equities swing with headlines about sanctions and manufacturing output. Banks publish scenarios linking price to catalyst loadings, energy costs, and electrolyte supply chains, illustrating how macro twists translate into daily moves on the screen. Industries and investors feel the ripple effects differently. Automakers in Europe and Asia monitor palladium inputs for catalytic converters, while jewelers adjust designs as platinum becomes a price anchor for luxury pieces. Mining firms in South Africa and Russia face running costs, worker safety campaigns, and capex needs to expand capacity. ETFs, wealth managers, and family offices reweight portfolios toward metal equities or commodity funds. Banks price risk into derivatives while central banks observe macro flows that could tilt currency and interest rate expectations. Small traders react to headlines, charts, and brokerage alerts. Policy signals from sustainability rules could also shift long-term demand for platinum catalytic uses. Geopolitics shape metal supply and policy costs. South Africa remains a core platinum and palladium producer, and labor strikes or power outages there can stall refineries. Russia and sanctions risks echo through palladium markets because a chunk of supply has flowed through sanctioned routes. Chinese growth, European emissions norms, and US inflation dynamics influence car demand and industrial spend. Currency moves also matter. A stronger dollar often depresses commodity prices, while inflation pushes investors toward hard assets. The energy transition adds pressure for steady access to catalysts, while geopolitical tensions keep traders alert to headlines and risk premiums. Markets price in policy shifts and supply disruptions. Smart money moves show subtle shifts rather than dramatic bets. Hedge funds have tilted toward palladium exposure when auto output looked robust, then rotated to platinum or diversified metals as supply scares receded. Large pension funds and sovereign wealth groups favor liquidity, using exchange-traded products and futures to test scenarios without heavy capex. Retail traders observe news spikes, funding rates, and sentiment surveys, often buying dips or selling rallies into key support levels. Analysts compare forward curves, inventory data, and refinery runs much like chefs tasting a recipe, adjusting their positions as new ingredients come into view. The takeaway is flexibility wins. Palladium could face a prolonged auto downturn, non-combustion engines, or policy shifts that reduce catalytic demand, sending prices lower as supply remains elevated. Platinum could underperform if jewelry demand softens or new refinery tech lowers input costs, diminishing scarcity premiums. Liquidity squeezes, margin calls, or a sudden broad sell-off in commodities could amplify moves, triggering forced selling in ETFs and futures markets. Geopolitical shocks or sanctions that lock in limited supply would create rare spikes instead of stable markets, testing risk management for producers, investors, and lenders alike. Bear cases rely on stress tests, scenario analysis, and disciplined position sizing to weather volatility. For retail investors, the answer is not to chase one metal, but to build a balanced approach. Start with a clear objective. Hedge, speculate, or gain long-term exposure. Consider slivers of palladium and platinum through ETFs or mining stocks, complemented by broad diversification across commodities. Use dollar cost averaging to avoid timing pitfalls, set stop losses, and track car production trends, refinery margins, and economic data. Don't ignore costs. Storage, financing, and roll yields matter. Finally, pair metal holdings with sustainable policies and clean energy narratives because regulatory shifts can suddenly tilt fundamentals in unexpected ways. Patience and education pay off longer term. Looking ahead, the platinum-palladium narrative will hinge on supply discipline, technological demand, and policy direction. If automakers curb palladium usage or platinum substitutes emerge, prices could recalibrate quickly. Otherwise, steady demand from industrial catalysts and jewelry could keep both metals in play, with platinum offering a larger upside when macro risk is high and palladium protecting corners of the auto cycle. Investors should simulate scenarios, diversify risk, and monitor inventory levels and mine action. In any case, stay curious, disciplined, and informed. If you found this valuable, subscribe to the Commodity Brief for weekly insights on alternative assets and commodities.